Interest and dividend income paid by an investor-owned corporation. We covered that. Okay, so the last thing that we're going to talk about in this class is depreciation. And this will affect us from now until next May, because every time we do some sort of financial analysis, we have to take into account depreciation. What kind of an expense is depreciation? What do accountants call depreciation?
Non-cash.
Non-cash. What does that mean? Why?
It's not an actual cash outlay, it's just something that goes on your income statement that you have to add back later.
Exactly. So depreciation is a non-cash expense. So what does that mean? It means unlike your employees, where you write a check every 2 weeks to pay your staff, you do not sit back and write a check to depreciation. It's a non-cash expense. It's a tax-deductible expense because the government recognizes there is wear and tear to machines and buildings. So that has an implication for the taxation. So we've got two hospitals here that are identical in every way except their depreciation expense. Hospital A has only $100,000. Hospital B has $200,000 of depreciation expense. So that results in a different taxable income. The fact they have different taxable income, because depreciation is a tax-deductible expense, produces different taxes. $80,000 for Hospital A and $40,000 for Hospital B. That results in different after-tax income. So basically, what's happening here? Why are the net cash flows different to these organizations?
The higher the depreciation, the higher the net cash flow.
Right, so what's Hospital B got going on for it here? It's got a lot more depreciation than Hospital A. So it pays a lot less tax. That is called a depreciation tax shield. So what that means is that by increasing the amount of depreciation, if you buy a lot of capital assets, that increases your depreciation expense, that reduces your taxes, because depreciation is a tax-deductible expense. So at the bottom, you can see the after-tax income of Hospital B is lower than Hospital A, but then I add back in depreciation to get net cash flow. Why do I do that? What's the meaning of all that?
You don't tax depreciation, so you add it in after you tax everything else.
Right, so according to our income tax return, Hospital B is much less profitable than Hospital A because it had a lot more depreciation expense. Its net income is lower. Its after-tax income is lower. But in fact, depreciation is a non-cash expense. So if we want to know what the true cash flow is to this organization, we have to add back in depreciation to get the net cash flow. So yes, Hospital B is less profitable from a taxation perspective, but in fact, it has greater net cash flow when we add back in depreciation. So it's the net cash flow is really of what is greater interest to managers than the reported taxable income. You as managers will be most concerned with cash flow in and out of your organization's bank account. Manipulations that accountants do are important, but they are not always directly relevant to financial decision making, and I'll emphasize that over and over again. Here's a not-for-profit corporation. So I'm not going to go through it, just tell me what you think. What's going on here? Not the same result, is it? So why are the net cash flows the same?
There were no taxes, so there was nothing to be shielded from.
Exactly. There is no depreciation tax shield. If the tax rate is 0, then there is no depreciation tax shield. Both of these organizations have exactly the same net cash flows, because there's no difference in taxes, there's no difference in depreciation tax. So for-profits and not-for-profits have very different incentives and financial realities around taxes and depreciation. So how is depreciation calculated? Well, accountants, when they're putting financial statements together, typically will use straight-line depreciation. Straight-line depreciation is the cost of the asset minus its salvage value. What is salvage value?
What you sell it back for.
Yes, what it's worth at the time of the asset's useful life coming to an end. Can anybody imagine a situation that being negative?
Maybe if you have like loans on it or something and you can't use it anymore, but you still have to pay back, if you're loaning it or that way, I guess.
Okay, the loan is typically not taken into account when you look at the value of the asset. Just like a piece of machinery or a building, regardless of how it's financed, what is its value? I'm asking whether you could see negative salvage value.
For some reason, there was no depreciation and the value of the machinery went up as opposed to going down. I don't know why that.
Okay, you're on an interesting track, which we'll talk more about in a minute. Julie.
I would say just zero. I mean, if it has no value, it has no value. How do you get a negative value?
That's what I'm asking you.
Sometimes in the case of medical equipment, for example, the salvage value is zero, but then you have to pay some engineer to take the equipment away from the hospital and dispose of it.
Exactly. There are lots, healthcare, hospitals in particular, have got a lot of dirty business, environmental concerns. Anytime you drive by a gas station, you see the place where an old gas station used to be, what do you see? Digging up the ground, all the earth around it, because there's probably environmental damage. So, nevertheless, accountants will calculate the straight line depreciation by taking the value of the asset minus its salvage value over its useful life. So we have an X-ray machine, costs $100,000, costs $10,000 to deliver and install it, and it's worth $5,000 at the end of its life. Accountants will calculate a depreciation expense of $10,500.
My question had to be, you had an example where you had the two different depreciation.
Yeah.
I was wondering, what does it mean, like if you have a lot of depreciation, what does that mean for your organization? Like, does it mean like you have too much equipment or too old equipment? Like, what does that mean?
You cannot, that will be a great question to ask when we talk about financial condition analysis, when we talk about average age of plan and so on. Right now, there's no easy, simple way to answer that question. Some hospitals, some healthcare organizations overbuild, and they have very high depreciation expenses. Very high depreciation expense could indicate they have overbuilt. On the other hand, it could be that they've just got a very high tech, high complexity kind of.
That'll last longer.
Right. No depreciation would be a very worrisome sign. I, as a patient, would not go to a healthcare organization with zero depreciation. Because that means essentially they've written off, all the equipment in that organization has been written off. So what they do, so this is how accountants calculate straight line depreciation. They value the assets $100,000. They add in the installation cost because that is the cost of acquiring the asset. And it's going to be worth $5,000 when they get rid of it. So they divide that by 10 years. So $10,500 is included as a line item on the income statement of the organization every year. There was $10,500, and they will do that for how many years? 10. For 10 years, and then the value of the asset is 0. And it's written off. It's removed from the books. Uncle Sam has a different method. The federal government, the IRS, has a system called MAKERS or MACRS, depending on where in the country you grew up. And it's called a Modified Accelerated Cost Recovery System. And this is used for tax purposes only. The standard method and the alternative method. I'm going to only go through the standard method. The standard method includes 3 components. The depreciable basis, which is what is the total amount to be depreciated. Salvage value is not recognized by the IRS. So that's an important difference between the accountant view of the world and the IRS view of the world. It's just the capital cost of the asset. The recovery period of the class life, which is the number of years over which the asset's going to be depreciated. And finally, the recovery allowances. This is the annual amount that the federal government allows you to write off, to reduce your taxes by writing it off. So let's go through this. The same example. We have an X-ray machine, $100,000, $10,000 to deliver, install, falls in the maker's 5-year class. Now this asset uses a 5-year class, even though it may only last 4 years. So what the half-year convention means is that when you buy an asset, typically you will not buy it on January the 1st of the year. You will typically buy it some portion of the way through the year. So the depreciation of the asset, even though it's going to last 3 years, it will cover 4 taxation years. So that is why the government says if you've got an asset that's going to last 3 years, we depreciate it over 4 years. If you have an asset that's going to last 10 years, we depreciate it over 11 years. And here are the basis. This is the maker's data. This is an asset that lasts 5 years. We're going to take the $110,000, and there are the different allowances per year. So what that means is the following. The $110,000 is the depreciable basis. It's the value of the asset, capital cost of the asset. 20% of that is $22,000. So the IRS will allow this organization to include $22,000 of depreciation expense on its income tax statement that year. The book value is then $88,000. What does that mean? How's that calculated? Where's it coming from?
Basis minus depreciation.
Right, so what that means is at the beginning of the tax year, the asset's worth $110,000. At the end of the tax year, you've claimed $22,000 depreciation, so the value of the asset is now only $88,000. So that $88,000 is the book value at the end of the first year. At the beginning of the second year, 32% of the $110,000 is allowed, so that's $35,200. And again, the book value then falls to $52,800. You can see as it gradually goes down to the end of the 6th year where the book value is 0. So from the IRS perspective, you've written it off at the end of the 6th year. So one of the interesting questions is then, what happens if this organization, at the end of the 3rd year, what is this asset worth according to the government? $31,900. What happens if the organization sells the asset for $40,000?
They're taxed on
What do they get taxed on?
the difference
Okay, why?
because they, I guess, overestimated how much the depreciation would be, so now it's a income tax.
It's a capital gain. That's right, that's the right explanation. If the government says the asset's worth $30,900 at the end of the 3rd year, and they sell it for $40,000, essentially there is a capital gain of $8,100, and that will be taxed when they go to submit their income tax return. They will have to include $8,100 capital gain. They will pay tax on that. What happens if the asset is worth $31,900 and they sell it for $20,000? Say what?
A discount later. It comes
Discount
out.
later. Tell me what you mean by that.
So from what I understand, then you wouldn't have as much tax on your, like it would be subtracted from your income, and then you wouldn't be taxed as much on the overall.
Right, so the opposite to a capital gain is a capital loss. Because what that means then is that you haven't taken enough depreciation, and so you can claim that as a capital loss in your income tax. At the beginning of the recession, the president, one of the things he did was he changed those allowances for many kinds of assets for healthcare organizations and other corporations as well. Instead of 20, 32, 19, 12, 11, and 6, he had 100, 0, 0, 0, 0, 0. Why did he do that?
Say it one more time.
Sorry?
So if after the first year, then the book value of the machine or instrument will be zero, and then if you happen to sell it or do anything with it, then it'll be considered a capital loss because it's only worth zero at the end of the year?
Okay, you're circling around it, circling.
Because companies that sell equipment after the first year, they will pay capital gain tax.
Okay, if that was 100%, how much would the organization,
So your tax shield, depreciation tax shield would go through the roof, and that's like an influx of money to your organization.
okay, and what would that do? You're right, that's,
Allow you to invest that further in the organization.
and how would the president benefit? What did the president see, why did he do it?
Pumps money into the economy.
Yeah.
In what way? You're
Well,
right.
you know, by yeah, buying and selling resources.
Exactly.
You know, it's jumpstarting the economy.
Exactly, by making that 100,000,000, that gave corporations huge financial incentive to go out and load up on capital equipment. That's providing a stimulus to the economy. So these look like just numbers and tax rates, but in fact, there are huge financial incentives built into the tax system. And again, this is just a 50,000 foot view of it.